Money Vikings, welcome back to the channel. Thanks for joining me. I have a very important one to talk about today in light of all the stock market turbulence. And I did, title this tongue-in-cheek, sell everything now, it's all crashing and burning, get out now, sell it all. Yeah, I'm being dramatic to make a point, and I'm going to go through the big three reasons why there's absolutely nothing to worry about a market correction, and what to do if a person is actually really worried. So let's just dive into it here. So the first thing I'm going to bring up is I want to look at a couple of charts with you, and I want to show something and talk about something. So I'm going to talk about the S&P 500. That's not the entire stock market, but that's usually that. The Dow Jones Industrial Average and the S&P 500 are typically what is talked about when people talk about the stock market. And typically people are, for the most part, the average person's 401ks are invested in S&P 500 index funds of some kind or another. If they have any kind of, stock-focused index, that is typically the benchmark for it. Now, we all know there are 1,000 other investing products out there, so you have to keep that in mind. There are different sectors, there's information technology, there's healthcare, there's consumer staples, there's almost everything you can think of. You can buy individual exchange traded funds that focus on semiconductors and chips. So there's everything out there. And in addition to that, it gets a little more confusing because there's also index funds or ETFs of small cap companies. There's indexes of mid cap companies, and then there's large cap companies. But the S&P 500 are the 500 largest companies, most powerful companies across a whole broad range of different industries. And so a lot of people, myself included, I hold index funds that basically mimic the S&P 500. And the S&P 500, we can look at it here. The S&P 500 has your typical, sort of investments in it that you've probably all heard of. So let's just look at that real quick. Let's look at the S&P 500 top holdings, because that'll tell you essentially what you're invested in. So you think about it, it's got things like, the top holdings: Apple, Microsoft, NVIDIA, Amazon, Meta. These are the kind of stocks that you are holding in your 401k or your thrift savings plan or your IRA, whatever it is, if you have an S&P 500 index. So that's typically what people talk about when the news media says the market is crashing, and the market dropped as it did at the beginning of last week, and by the end of the week it had basically recovered, right? So I want to talk about it though, because there might have been a lot of people that sold everything the day that it dropped and they freaked out. But I want to just go over real quick. So check this out. You see you have Google, that's Alphabet, you have Berkshire Hathaway shares, Eli Lilly, and it goes down for 500 companies, right? Chase, Eli Lilly, United Health, Visa, Procter & Gamble, Johnson & Johnson, Costco, Home Depot. You can, of course, buy individual shares in these, but people really don't, and even me, myself, who's into investing, you don't always want to spend all day long looking at individual stocks, when to buy and sell them, so you just hold the S&P 500. And what's kind of beautiful about it is it's a self-cleansing thing. So I'm going to talk a little bit more about that. But as companies get weaker, and they will fall out of that, and stronger companies will go back into it to keep it into the 500 strongest companies. So with that, why am I not, again, with the title, I'm being a little bit tongue-in-cheek here, why am I not worried? So let's look at the last 5 years, okay? So the S&P 500, this is the last 5 years. March of 2020, that's when we had the COVID drop. I knew several people that sold a lot of their stocks, and they freaked out during COVID, so they sold at the bottom right there and stayed in cash. Well, look what they missed out on. Tons and tons of growth. Okay, went down a little bit for leveled out a little bit for a couple years, and right here in, October of 2023, it just started moving right back up. And then here we go, we had that bit of a drop a couple days ago, so it dropped down a little bit. That's a 5-year look. But what I really want you to look at is this, because you've got to discipline yourself as an investor to really deal with what the media is feeding you, okay? The media is trying to get your eyeballs and your interest so they can sell advertising. Okay? There's nothing wrong with that, I guess, in any way. But the point is this: they have to find dramatic things to say to you to get your attention so that it's very scary, right? And then you're gonna watch the commercial for whatever their advertisers are selling you. So they're going to say, well, oh my gosh, it's everything's dropping. And then the other thing that really kind of I find really funny is there's a bunch of like billionaire investor types that they're always kind of doing a doom and gloom thing, like the market's going to drop, it's about to drop. And it might. I mean, next week it could drop. No one knows. But here's what I want you to look at historically, okay? I'm going to close this one out, and I want you to look at this chart here. So this is the S&P 500 index from 1936 up until 2021. And what you're seeing here are all of the things that people and humans around the world could have freaked out about. And as you'll see, look at the trend, okay? The trend is it goes up. Yes, in the smaller time frames, there are these dips. It does dip down for a while. It falls back down, okay? But then at some point it picks back up and goes up. Then it brushes down, and then it picks back up. But you can see all these things. German occupation of France in World War II. I mean, what was worse than World War II? But if someone bought stock in the S&P 500 at that time and just held on to it, let's say the person at that time was 20 years old and they bought a bunch of S&P 500 shares. In 30 years from that point would have been 1966. So let's just go out to 1966. Well, look, I mean, it went all the way up. I mean, it looks like almost that they like tripled or quadrupled their money. That probably doesn't even include dividends being reinvested. So they didn't lose out. And all that time, things happened. There was the Cold War. There was the Vietnam War. Awful. There was an assassination of a president. An actual president was assassinated. Okay. And guess what? The stock market, it probably dropped the next day. I don't know. I'd have to go look back specifically to that day in infamy. But over the long term here, which is years, it went back up. Sputnik was launched by the Russians during the Cold War. Oh, that was scary. There was discontent on college campuses. You ever heard of that before? Well, here it is. I mean, my point is the media is just going to freak you out and and you're going to have this urge and this feeling of sell everything, run for the hills. It's awful. Everything's falling apart. Well, that's just has not played out since 1936. I'm going to bet that 2024 and beyond is not different. There's going to be various problems and issues in the world. Humanity's always going to have things. There's always seems to be wars and conflict and social injustice and different things that happen, which we work through. Hopefully things get better over the long arc of human history. I want to believe they do. I think they do. But my point is you have to really look out through the long arc. So if you don't want to be, watching these things every day, it just proves that you really don't have to. I'm going to tell you why in a minute, but I'm going to keep going through some of these things. You had, the Iranian Revolution, the AIDS epidemic, the Gulf War begins. There was a Mexican peso crisis. I don't remember that one. The savings and loan crisis. I do remember reading about that. That was a big problem with the banking financial system. Heard of that? Yeah. Look at this, 9/11. Our country was attacked by terrorists, and the worst terrorist attack probably since, Pearl Harbor wasn't a terrorist attack. It was another country. But, we were attacked on our own soil. All kinds of things here. COVID-19. Okay, COVID-19. But here's the thing, even with COVID-19, you saw the drop and it went right back up. In fact, it kept going up for years and years and years. Okay. Here's another one, just another one like it here, where you can see this only goes out until 2017. It's funny, it has a question mark, like what's next? What's the next shoe that's going to drop? And we didn't, of course, a couple of years later, there's going to be a global pandemic, right? So that's that. But yeah, so you can just see here, the various drops. This shows you the biggest drops. So the stock market crash, 89%. So that was pretty bad. But here's the deal. I was in the middle. So 1935. But if a person just held their shares, it actually goes right. It goes back up. It took a while. Okay. And granted, that one took a while. right? To go from the stock market crash of 1929 to get back, but it did go back up. So so theoretically, someone that was working from 1935 to 1950, I mean, that's 15 years. That's 15 years. People work and invest for 15 years. They were buying a bunch of cheap shares that kept growing in value, so they didn't lose everything. And there's three reasons why I want to get into this. So the first reason I'm not worried, and I don't get too worried about this stuff, is that number one, the S&P 500, as I mentioned earlier at the top of the video, is self-cleansing. Okay, so it continually evolves and changes. All right, so that's number one. Number two, throughout the whole turbulence, you kind of want the turbulence if you're a long-term investor because you're dollar cost averaging. When you do have these little drops down below, you're buying more shares at a cheaper price. And those are just going to go up again. Then it drops again, you buy more shares at a cheaper price. So if you're continually just investing every couple of weeks or every month, you're dollar cost averaging. And then the third concept that I want to talk about that's really critical and was really a major change in my investing journey is that there's not really a magical day when you are selling everything and taking it out of the market. You are building a portfolio that is tailored to your risk tolerance, right? So if you want less risk, you're going to do less of the S&P 500. You're going to do more bond funds, and you're going to do maybe more CDs. You got to do something though, because cash isn't good, as we've talked about many times before. Cash isn't good because inflation is going to erode it. You keep that in a cash savings account, getting 0.1%. Every year, you're actually losing 3 to 4% as inflation continues to go up. Okay, so the money has to be working for you in the market. But at the end of the day, what you're trying to do is create a passive income machine where you have a certain nest egg. You're never like just taking out, if you get up to 500,000, it's not like there's a magical day you retire and just take it all out. You're basically then going to start drawing 5,000 a month off of it. I'm just making that up. It's going to probably go along with the 4% rule, but you're going to draw 5,000, 6,000 a month off of it, and then also let it grow over time. So those are the concepts there. The last thing I'll leave you with is this. If the recent events have really freaked you out, then you got to look and you have to do research and study your own personal investment risk profile. So again, I talk about it. If you just can't stomach to see your account go from $100,000 one day, and then a week later it's down to 70,000, and you have this compelling urge to sell everything and lose $30,000, that's when you lose, when you sell, then you probably need to talk about your risk tolerance with yourself and with an advisor. So you want to say, hey, can I stomach these downs? Can I get through them to get more ups? Or do I just need this to kind of be really slow and steady? So it's not going to grow quite as much, but it's also not going to drop as much. And that's why people will add some bonds and exposure to less risky assets, CDs that pay 4 or 5%, maybe some real estate investment trusts or whatever. But basically, that's a mindset that you want to develop. So, hey, thanks for watching. Catch you on the next one. Please like, subscribe, do all that great stuff with the channel. I appreciate it. All right, see ya.